Once again, thank you for attending the presentation. I appreciate your interest and engagement. Today we are going to discuss about wealth creation. I'll just share my screen. So, we all take investment decisions based on the information we have, right? So, the idea today is to share some insights which can help you to take right decisions in your life. When we talk about wealth creation, we say uh, it is not about how much money you make, it is about how much money you keep aside and how hard that money works for you and how many generations you are keeping it for. Uh, so, uh, before I start the presentation, I'll just give you a brief about me. My name is Jose Thomas. I am one of the director with Elixir Wealth. I started my career in Bangalore in 2005, and I was in a stockbroking company there till 2008. And I came to Dubai in 2008, started working for a multinational bank here. And I left banking after 2.5 years. And from 2010 onwards, I became an independent financial advisor. So one of the success story that I have is that in 2010 there was one new fund offer came into the market called Nippon India Small Cap Fund. Those days it was Reliance India Small Cap Fund. So I actually went and spoke about this fund to different people, and the largest amount I could manage to collect was 25 lakhs. And this person who invested this money was around 33 at that time. And today, after 14 years, this fund has given more than um, close to 18 times returns. So that means this 25 lakhs, which he invested in 2010, has become close to 4.5 crores today. And when I talk to this client of mine, what I tell him is that yes, we have made 18 times returns, but the exciting part is that the next 4 to 5 years, this 4.5 crores can become 9 to 10 crores. So once we reach to that level over a period of time, we can definitely say that yes, we made a difference in their life. Uh, so somebody who has invested 25 lakhs, for that to become 9 to 10 crores is a big deal. And this is my success story. And in 2002, almost 8 years prior to Nippon India Small Cap Fund, this Sundaram Mid Cap Fund was started. Again, this is also an above average performing fund. And if you look at this, from 2002 till 2024, it's been already 22 years. So, over a period of 22 years, this fund has given a return of 133 times. So, that means somebody who had invested 25 lakhs in 2002, today the value of that 22 lakhs is more than 33 crores. So 8 years of difference made a huge difference here. Um, the fund which started in 2010 had given 18 times returns, but the fund which started in 2002, 8 years prior to 2010, has given more than 133 times returns. If you go a little while back, in 2000, sorry, in 1995, there was a new fund offer from Nippon called, again from Nippon, called Nippon India Growth Fund. And this fund, somebody who had invested 25 lakhs in 1995, 25 lakhs was a big amount. But somebody who had invested 25 lakhs in 1995, today he has got more than 400 times returns. So that means um, in a mutual fund, um, just investing in a mutual fund, and we are not doing anything about it. We are just leaving that money there, and this fund is keep on growing. And over a period of 29 years, we are getting around more than 400 times returns. So that 25 lakhs became more than 100 crores today. That's how compounding works. That's how we need to conceive our investments. So investments are like not for short term. This needs to be invested for a long period of time, so that the money will slowly start working for us, and we will create wealth where we don't have to think about money. And today, if you see the same fund, you can Google it, Nippon India Growth Fund. It's not 400 times returns. 400 times means 25 lakhs becomes 100 crores. But 1.5 months later, this I took it on July 30th. Today, as of today, it is 103 crores. It is again appreciated. So that's how we create wealth for our clients. So now, um, in the early years of my career, I used to come across people who used to say that I used to invest in Indian market, but I was not getting adequate returns, so that I withdraw my money after some time. So when I used to look at their portfolio, actually they are thinking that they are directly investing in mutual funds, but actually they were investing in ULIP plans, unit linked insurance plans. So that what happens is that a unit linked insurance plan had many layers of charging. So ultimately, the money will be invested in stocks and in mutual funds, but the charging was very high, where they in the first year they used to take out 30 to 40 percentage, in the second year around 15 to 20 percentage, third year again they used to take money, upfront money. So it was not because, what I meant to say is that it was not because the market did not perform or the funds did not perform. It was the product that did not perform because of the huge charges. So, what I meant to say is that if we are investing our money into right funds, into right places, uh, this is how we make money. The compounding will take the remaining job. Uh, so, normally, what happens is people most of the people I come across, they invest their money, but they might not have a clear picture about where exactly they invest their money, and the idea what they have or the knowledge what they have will be very less, so that they don't know what are the fees associated with it, what are the goals we have, where all we are investing. All these ideas, most of the time, um, the investors doesn't have all these ideas. So before we invest our money, it is actually very important that we go through the details, understand the fees, cost associated with it, and then you take an investment decision. That is very important. And when it comes to dollar based investment, one of the easiest way to analyze whether we are in the right direction or not is to see that what percentage of our money is invested in ETFs, exchange traded funds. Exchange traded funds are one of the most cost effective way to invest our money. When a normal mutual fund charges close to 2 percentage on an yearly basis, an ETF will cost you maybe 0.15 percentage or 0.2 percentage. Uh, and this is one of the ETF from iShare called iShare Semiconductor ETF, where this ETF has given an average, not average, over a period, over a 5 year period, this ETF has given more than 300 percentage return. So that means um, somebody who had invested, let's say, 500,000 5 years back, today the value of that 500,000 is more than 2 million. Or somebody who had invested 100,000 US dollars 5 years back, today the value of that 100,000 US dollar is 400,000 US dollars. So when we say 5 years, um, almost 4 years back, um, UAE property and the property prices were very low. And now, if you see, the property prices are skyrocketing, and it has gone to a different level. And we all say it is at peak. So, somebody who had invested in a property here, they could manage to double their wealth. That means they invested for 3 million. Now, uh, people are ready to buy the same for 6 million. So they got double the returns. But compare that with this instrument where this has given 300 percentage return. So if you had invested, if the same person had invested 3 million, it would have been 12 million as of now. So that's the difference here. And so when it comes to long-term investment, we invest into these kind of instruments, which can, over a period of time, which can this can create wealth for us. And during fluctuations in the market, we take market fluctuation into account as part of portfolio management. And if you look at this instrument, this is again an ETF, but a leverage strategy ETF. So this is three times leveraged. So that means if the market goes up by 1%, because of the leverage strategy, this instrument will go up by 2%. Sorry, 3%. If the market goes down by 1%, this will go down by 3%, and it will have a compounding effect. So because of that, it is highly fluctuating. So when the markets are down, we invest into these kind of instruments to maximize the profit. If you look at this, in 2020, during COVID correction, the NAV of this instrument was around 4.6, and from 4.6 in 2021, it came up to 68. So it had given close to 17 to 18 times returns over a period of 1 year. And in 2022, when the Russia-Ukraine war started, because of that, the oil prices went down, and that led to inflation and interest rate hike. So that the market went down. So that what happened was from 68, it went down to again around 7, and again it went up. So we actually, when we create the portfolio, when we get opportunities in the market, we invest into these kind of instruments as well, with uh, not big amounts, small amounts, to maximize the profit. So when we make our investment, it is very important to understand where exactly we invest our money. So, as per studies, 86% of the portfolio returns are based on asset allocation. So, it is very, very important that we invest our money in right places and right segments of market. This is one of the way we diversify our portfolio. So, we keep around 20 percentage in stocks. So that means we invest into some of the major stocks, some of the high performing stocks, to to get the benefit from the market performance. And around 20 percentage will be invested into ETFs, exchange traded funds. That too, we invest into semiconductors, robotics, which is like artificial intelligence, and we invest some money into S&P 500. And when it comes to Indian investments, we invest into mutual funds in India mainly because India is a more dynamic market where on a monthly basis we will have 3 to 4 companies coming into Bombay Stock Exchange. So we need to identify, analyze, and invest into those companies as well. So um, a mutual fund which is actively managing the funds, we select a mutual fund which is actively managing the fund and invest our money into that. And India's growth story, everybody is aware of it. And if you're already investing in Indian funds, you know what percentage of return people are getting. People are getting more than 20-25% return on an average. So we take India opportunity as well. And as of now, based on the current market condition, we keep some money in gold. We keep around 10 to 15% in gold, so that if the market goes down, we can take out the money and invest in gold, and we keep around 20 to 25% in hedge funds. Hedge funds are not actually directly linked to equity market, so that we keep a certain amount of certain percentage of the money in hedge funds as well. Uh, this is one of the hedge fund. The reason why I actually added this is because I just wanted to show you this fund in 2022 when the markets were down all over the world. This fund has given 15 percentage return, if you see, and in 2023 it has given 16 percentage. In 2021, 24 percentage. So it consistently gives returns. But if we get an opportunity in the market, we can take out money from these funds and invest again into equity. And this is one more hedge fund where if you see 2022 performance, it has given 48 percentage return. So just to explain you that the hedge funds or long short funds are not directly linked to equity market, so that when there is no opportunity in the market, we can keep a large portion of our money into hedge funds, commodities, and bonds. This is all part of portfolio management. So now we will come back to the next. This is a calculation where let's say how a normal person can create wealth. This will show how a normal person can really create wealth. Let's say uh, you are somebody who can allocate or you can invest around 75,000 US dollars today, and let's say for the next 10 years you are contributing 4,000 US dollars a month or 48,000 US dollars a year. This is just a calculation. This is not a plan. This is not a product, or this is not a bank EMI. You are not locked for 10 years. You have the choice or option to invest if you want, or if you don't want, you cannot, you don't have to invest. So you will have all the flexibilities, but this is the calculation. If you are investing 75,000 US dollars upfront, and if you contribute 4,000 US dollars a month, which is 48,000 US dollars a year, and let's say you continue this for the next 10 years, and assume that we get 14 percentage growth on our investment and compound frequency monthly. So normally compounding happens on a daily basis from Monday to Friday, but uh, daily if we calculate it, it doesn't make sense. So monthly we are calculating compounding, so that over a period of 10 years, if we contribute this amount, we will end up contributing around 555,000 US dollars over a period of uh, 10 years. And assume that we get 14 percentage of growth on an yearly basis. On an yearly basis, we are getting 14 percentage growth. So that what happens, our 555,000 US dollars becomes close to 1.33 million. So after 10 years, our contribution is 555,000, and that becomes 1.33 million. And after 10 years, we are deciding that we are not contributing anything further, but we are just leaving this 1.33 million in the funds in the portfolio, and we assume that this 1.33 million again will grow at a rate of 14 percentage, but there is no monthly contribution. So what happens is that after 20 years from today, our total investment of 555,000 US dollars becomes 5.38 million US dollars. So normally I come across people who can invest 75,000 US dollars easily, and they can contribute 4,000 US dollars a month for the next 10 years. So this is a calculation where, you know, it shows how 555,000 becomes 5.38 million. over a period of 20 years. So this is an idea where if we have 4 to 5 million, in my understanding, you can stay anywhere in the world. You can stay in UAE, you can stay in European countries, Australia, wherever you want, you can go and stay there. The idea is like if you have, let's say, 5 million US dollars, 6 percentage of 5 million US dollars is around 300,000 US dollars. That is more than enough for anybody to stay anywhere in the world. So that's the calculation, and that's the vision we have. So our idea or the vision is whoever associate with us is to take them to financial freedom, so that they don't have to worry about money all the time. So if you systematically keep aside money and review the portfolio on a regular basis, um, you will be able to achieve all your financial milestones. So that's it from me. It was a very short presentation. Hope you understood the idea. And if you have any doubts, you can message me.